Thank you for joining us for today's webinar. This is a really hot topic today. It's hot in two senses when it comes to the middle markets and the lower middle markets. So what we're talking about today is rollover. So think of it as retaining a percentage of the business as opposed to selling 100% of the business. And we'll discuss a little bit later why it's technically different than retaining. But to get started, just think about that. And I say that it's hot, and it's hot in two meanings of that word. The first one is there's a buzz around it. It's happening all the time in deals right now. It's becoming increasingly common, and it's a way to get deals done at great valuations. And so it's hot in that sense. It's kind of the newest thing in the industry. And then it's hot in the second sense, kind of like touching your hand on a hot stove. It can burn you. And you know, the main way that it can burn you here is it's complicated. You know, if you're selling 100% of your business, you have kind of a two-dimensional problem. You're trying to come up with documents and agreements that address a specific moment in time when the closing occurs, and that's it. But when you're doing rollover, you have all those same issues, which I'll kind of call a two-dimensional problem, and then you have the three-dimensional issue of building that new relationship that the seller will have with the acquirer going forward. And I said that's more complex because it's not as a fixed moment in time. You're trying to come up with agreements and documents to cement those agreements. They cover a span of time and all the various things that can happen over time. So I consider that kind of a three-dimensional issue, or maybe a variable with three equations versus a variable with two equations. So instead of just solving the two-equation variable, you have to do that, and you have to solve the three variable equation at the same time. So it adds a lot of complexity to the deals. But what we want to talk about today, break this into three parts. The first thing is why acquirers are using rollover so often. The second part is why sellers or clients are accepting rollover so often and why it may be right for you as well. And then the third part of what we're going to discuss today, we'll be looking at how you solve that three variable equation. And obviously that could be, you know, hours, if not days of discussion, but we'll kind of hit on the top 4 or 5 risks associated with that with rollover, and kind of the top 10 things you should be thinking about now if you're thinking about selling your business in the future. These are the kind of things to start thinking about now, and then obviously making sure you get hammered down with your broker and your legal counsel when the time comes. So let's get right into it. Well, before we do that, I want to say, as always, we welcome questions for the audience. I've reserved time at the end of the webinar for those questions. And the way that you would send the questions, as you'll see in the upper right-hand side of your screen, a little bar, there's an orange box with an arrow. If you hit the arrow, the box will pop open, and you will see a place there that you can ask questions. I have Sydney with me here today off camera, and she will be taking the questions. And we've got, she'll throw them out to me at the end. And if we don't get to anyone's questions, we'll be sure to follow up after the webinar with the person that asked the question. You'll also see there are 3 PDFs available for download. 2 of those are about benchmark. And well, they're all 3 about benchmark, but 2 of them are generally about benchmark. And the third one is something different. I don't think that we've posted in a webinar before. But it's how to follow us on social media. So if you like the content that you see in the webinars, we have similar content of similar quality going out through all different types of media through our social media outlets. So you can grab that, download it, and you'll know how to follow us if you want to hear from us more often than once a month on a webinar. So let's get on with it. Part 1 of the 3 things we're going to discuss today. Whoops, sorry, I forgot about my introduction. I mentioned it was hot. How hot is it? Well, last year, you know, every year we do a survey of our deals, and talking just about US deals, 75% of our 52 deals in 2020 had a rollover component. And this number, we look every year, and this 75% number has been growing every year for the last, at least say 5 years. So again, I said it's hot. This is one of the reasons. How much of the ownership does the seller usually roll over? 20%, and that's been fairly constant. We did see an increase in 2020, where 25% was appearing to be the new norm or the new average. That may have been a one-time blip due to some deals that were being set up by the acquirers early in 2020, and things changed in March of 2020, and in some cases debt got a little bit harder to get. The banks tightened up, and so they may have added a little extra rollover to kind of make up for things tightening up in the economy a little bit, and a little bit of increased risk due to what was going on. As we'll discuss later, rollover helps reduce risk for the buyers. So whether that bump from 20 to 25% was a sign of a new trend, or whether it was a blip that will go away, we'll have to wait and see as we get into the new normal, or whatever people want to call that. But you should be thinking, when we're talking rollover, you're divesting 75 to 80% of your business, and you're retaining 20 to 25%. And in a situation where there are multiple owners that are selling, there is certainly no obligation that all of the owners roll over a similar amount. And in fact, that hardly ever happens. Almost always, the owners that are more involved in the management of the business, if there are multiple owners, will roll over more, and those that have maybe retired or kind of stepped away from the business will roll over less, or in some cases not roll over at all. So if you're in a situation where you're a multi-owner situation, your rollover could be significantly more than 25% or significantly less than 20% as well. But on average, when we talk about rollover, you should think about the sellers retaining or rolling over 20 to 25% of the business. So the rollover concept is more common with financial buyers, those being typically private equity funds, than it is with strategic buyers. So for strategic buyers, think about your competitors, your suppliers, your customers. Maybe they're trying to vertically integrate, or another business that doesn't actually compete with you now, but they're in an adjacent industry, or maybe they're in another country, and they might buy your business as a reason to a way to get into the markets that you're in. So strategic buyers use rollover a little bit less commonly, but again, talking about things heating up and this being hot, we are seeing strategics increasingly finding a way to include rollover in their deals. And when we go through the first big chunk of this presentation about why buyers are using rollover, you'll see that in order to compete with the private equity funds, the math is simply forcing them to include this in a lot of their deals in order to be putting forth competitive bids. So that's another kind of recent trend we've seen. 3 years ago, you weren't seeing strategics very interested in allowing or asking for rollover. Now they are. All right, so why rollover? Why are acquirers using rollover? And there's two main things that I'm going to discuss here. First, I'm going to discuss why they need to use it, which is a little bit of math. And then I'm going to discuss why they want to use it, because both of those elements play into the why rollover. So the first reason that rollover has become so common is cheap debt. Everyone knows interest rates just somehow keep getting lower and lower. So as long as they stay low, you should view that rollover is going to be kind of a mathematical, not certainty, but something that is going to drive buyers to seek rollover. So let's start with a simple example. Let's assume that your business has a value of $100, right? No one's business has that value. That's why I like to pick that number. Plus, we want simple math. So I'm going to use very round numbers throughout the mathematical discussions today. And this is the one where if you're ever going to get out a piece of paper, pencil, you might want to write this one down, because it's not a lot of math, but it kind of ends up in a different place than, in my experience, most of our clients are thinking when this example starts. So it's not tricky, but it's just a matter of kind of seeing it through a different lens all of a sudden, and then it's obvious. So get your pencil and paper out. So here's how the deal is set up. The buyer's going to use 50% debt. That may seem like a lot, and 6 or 7 years ago that was a lot, but we see a lot of deals where the buyer uses 50% debt. So if the purchase price is $100 and they're going to use 50% debt, then they need to come up with $50 from somewhere else, and the somewhere else is their own account. That's the equity investment that they're making. So if it's a strategic buyer, it's going to come from their balance sheet. If they're a private equity buyer, then that is going to come from their limited partners' commitments to provide equity capital. But in this example, what happens is in order to have a 20% rollover, the seller only has to part with $10 of the purchase price. And why is that? Well, when you're looking at the capital structure of a company, there are two parts. There's the percentage or the amount that belongs to the debt providers, and there's the amount that applies or belongs to the equity providers. And so the $10 in this example that the owner is putting in to roll over is part of the equity portion. So you don't count the debt. So you see the fractions there on the slide. The equity base of this company is only $50. So if I'm putting in 10 or you're putting in 10 out of 50, that's 20%. And the buyer is putting in 40 off of their balance sheet or from their limited partners out of 50, that's 80%. So you would own 20% of the equity, they would own 80% of the equity, and then there would be the debt on the side. And this table that I've now put up on the slide on the screen, this is something that should appear as a part of any letter of intent, particularly if there's rollover involved. If there's no rollover involved, typically the seller doesn't care too much about the sources and uses. But where it really becomes important is doing that math that I just discussed, the 10 out of 50 and the 40 out of 50. So a sources and uses table is the sources of the capital for the deal and the uses of the capital for the deal. Both columns have to balance and they have to add up to the purchase price, $100 in this case. So we see the debt, $50 in this example, equity from the buyer, 40, equity from the seller, 10, $100 is invested to acquire the business. And then you look at the uses, where does the money go? $90 goes into the seller's pocket and $10 goes to pay for the rollover. So in reality, this $10 never changes hands. It doesn't go from the buyer to the seller and then into the companies. There is no $10, but just kind of using accounting standards, this is the conventional way that sources and uses are portrayed. And the real important issue there is someone needs to do the math and make sure that in the sources table, 10 divided by 50 equals 20%, not 10 divided by 100. And you know, it's buyers will sometimes make that mistake. They will say, well, if you're going to roll over $20 in this scenario, you have to pay at 20%. You have to pay $20, and that's not correct, and it needs to be corrected. So it's not, that doesn't happen the majority of the time, and it may be more than single-digit percentage of the time where buyers, particularly on smaller deals, will not do that math correctly, and they need to be set straight before the letter of intent is signed, because as you can see, it has some serious financial consequences, especially if you sell your business for more than $100. So here's the source of my earlier confusion. Let me move to a second example, okay? In the second example, it's the same deal, but there's less debt. So the buyer this time uses 20% debt, right? So the first example was 50% debt. Now it's 20% debt. That was my confusion of seeing the 20% in the title last time. Okay, so this means that the buyer has to come up with $80 of equity in order to reach 100. So, but with this case, the seller only has to, or the seller has to pay, instead of 10, they now have to pay 16. The amount's gone up from 10 to 16. Why? Well, there are the fractions there, right? $16 divided by a total of $80 of equity is 20%. The buyer has to put in $64 divided by 80 to get 80%. Sources and uses table, the same elements, but all the numbers have changed to match the discussion on the left. Both sides still add up to 100. And the result is, instead of the seller taking $90 and owning 20%, the seller now takes only $84 and still owns 20%. Now the company has less debt on it at the end of the day, but the seller's taking away less cash at close than they would with the high debt level. So you see those high debt levels make the rollover very attractive to the seller. And most of our clients, when we walk through this with them, when an actual letter of intent comes in and we explain that, And this is why I said if you wanted to get a notepad out, they're a little confused about how, well, if it's, my business is worth 100, why am I not getting 80 and owning 20%? It's the magic of leverage, and it makes things attractive. So I want to go through that math. So when we get into why buyers are offering it and why sellers are accepting it, you've got a foundation, a numerical foundation underneath you there. So reason two, that buyers need to use rollover. So we haven't gotten yet to why they want to use rollover. We're still on why they need to use rollover. So high multiples. So as you probably know, multiples in the lower middle markets are at all-time highs. We've been saying that for several years, and they just keep getting a little bit higher. Eventually we won't be able to say that, but that's the market that we're in right now, fortunately. So what this creates, these astronomically high valuations, what this creates is a split between what the buyers want to pay and what they can actually pay. There's a gap there. When multiples revert to normal levels, that gap will shrink, if not be eliminated. But now the gap is there, and rollover, which I'll explain in a minute, is one of the things that helps solve for that gap. So they want to pay enough to win the process when there's a competitive process out there. They want to pay enough to encourage the owner to part with 80% or 90% or even 100% of the business if they could afford to pay for 100%. But they oftentimes can't get the cash. So, private equity right now has unprecedented amount of cash, but for some of the reasons I'll describe the next time we get into some math here, they don't want to use all the cash on every deal. They want to try to use as little of their cash as possible. But these private equity professionals have to put that cash to work. So they get compensated typically on what's called a 2 and 20 model. They get paid an administrative fee of 2% per year of all the assets under management. So if they don't take the dollars and invest them, they're not under management, they don't get a fee. And they use that 2% to cover their salaries and rent and all their other expenses. So they really want that 2% to be on the biggest base possible. And then the 20, I call the 2 and 20 model. The 20% is they get it, that's the carried interest you may have heard of. They typically get a 20% of the profit they make when the business is resold 5 to 7 years or whatever down the line. So they want to get that money spent as fast as possible to get that 2% fee up and to maximize the amount of gain they can get before they have to sell the businesses. So they get their 20% cut. And obviously there's variations on the model, but that's the standard model. But also, private equity funds have a finite life, typically 10 years. So if they go out to raise the fund and they secure $200 million in commitments from limited partners, and then 4 or 5 years in, they haven't called those commitments because they haven't done any deals, because they haven't put in competitive bids, because they're not being creative on deal structure and using things like rollover, the 10 years gets spent, they never called the money or didn't call all of the money from the limited partners. Well, guess what they have to do near the end of that 10-year fund? They have to raise their next fund. So if they go back to the same limited partners, the same investors and say, hey, I'm raising a new fund, will you commit some capital? Well, that investor is going to say, I committed, $20 million to your last fund. I left it sitting on the sideline for 10 years. And you only took like half of it. So no, I don't want to commit another $20 million to your next fund. And then I just have to tie the money up and have to worry about it. I'm going to go pick a money manager or a private equity fund rather that is going to invest all my money for me, because that's what I want done with it. I don't want it sitting on the sidelines. So they need to get out there. They need to be investing. And if they have to pay more than the business is worth sometimes, they have some very selfish reasons to do so. And the high multiples show that they often do. So they have to do these deals. So strategic buyers, right? We talked about financial versus strategic buyers earlier. Strategic buyers have all the normal reasons to acquire businesses. And right now they have 2 additional reasons. One, as I discussed earlier, is that really cheap debt. It just makes things more attractive, right? We all know that, right? The cheaper the debt, the more we want to use it. And businesses are no exception. And the second reason is, there are three reasons. The second reason is we know they have a lot of cash on their balance sheets that's been piling up for quite a while with successful companies. And then the third reason is kind of the recent disruption of supply chains is leading a lot of operating companies out there to try to find ways to remove the risks or the setbacks that they encountered over the last year when they couldn't get certain parts for their business, or some of the demand for their business dried up because other companies couldn't supply. If they can't provide cars, then you're going to sell less tires if you're a tire shop. So they're trying to solve all that by going out and doing acquisitions. So we have all this competitive tension going on in the market. The deal volume is astronomical and the prices are high, but money is limited, cash is limited. So in order to take advantage of the low debt and the other things I just discussed, buyers are really using a ton of leverage, as high as 50%. And we don't see that on all of our deals, but it is not uncommon to see 50% of the deal financed with debt. And so while these buyers are out there and they're what you would call exuberant about valuations, the provider of half that money, the lenders, typically banks or similar institutions, they're not people that get exuberant about anything. So they are enforcing the discipline to some extent on the valuations of businesses in the middle markets and lower middle markets. And tons of industry research out there, and what we're seeing on our deals, the most that these lenders will provide on any deal is 3.5 times the trailing 12 months EBITDA. And that's on any type of business. Some businesses will be lower, but it's never going to go above 3.5 times the trailing 12 months EBITDA, almost under any circumstance. So if a buyer wants to offer a 10 times multiple on a business and they want to use 50% debt, and the debt is capped at 3.5 times, how do they do that, right? Because if half of it is 3.5, you double 3.5, they're capped at a multiple of 7. How do you get above a multiple of 7 and keep that 50% debt ratio on the purchase price? Well, that's where we come in with what we call deal structuring, whether that be seller notes, earnouts, or rollover. So seller notes and earnouts have been around for a long time. Rollover really is kind of got its start after the dot-com bust. And this concept of, during the dot-com, the venture capitalists went in, they'd be a minority investor and they'd take, say, 20%. And in the sense they were kind of what the seller is now, the minority owner after that. And then kind of after a lot of people from venture capital went into private equity, they kind of had this idea, they brought it with them, and we've just seen it growing over the last 21 years, but particularly in the last, say, 3 to 5 years. So that's the second reason. Moving on to the third reason, why they want it, right? So there are 2 reasons why they need it. Now, why do they want rollover? So the higher the price paid by the buyer, the higher the risk is. They're trying to get a return on their investment of certain numbers, and the more they pay means the more they have to sell for to get that desired return. So higher price means more risk. Also, more debt or more leverage means higher risk. And as we said, debt levels are up to 50% of the purchase price in some cases. They have to service the interest, they have to pay off the principal. That makes their return on investment objectives harder to hit. So they're looking for some way to hit those return on investment objectives and take risk out of these high-priced, over-leveraged deals. So one way to do that is by not changing out the management. One of the biggest concerns that buyers have when they acquire a business is that, if the management team leaves and I have to replace it, that's just a new risk. I can get in there, I can do diligence on the management team, I can assume their future performance will be similar to their past performance, maybe even better if I improve their incentives and align them better with what I want them to do, but it shouldn't get worse. You bring in a new management team, you hope that it's better, but there's risk, it may not be as good. So with rollover, it's a way to keep an owner-operator on in the business and keep them properly incentivized, reducing risk. Similarly, alignment of interests. So I mentioned that briefly, but to keep it, as I mentioned earlier, historically, even when you sell 100% of the business, the owner, if they're an owner operator, stays on for 6 months to 2 or 3 years, and then transition processes in place. But the concern there is that the owner has kind of checked out. So by leaving 20-25% of interest in the business, the buyers then operate under the assumption that, hey, I'm in this to get a return on my 75 or 80%, and you, the seller, are in this to get a return on your 20-25%. Our interests are aligned. That's the second way that rollover helps reduce risk on these high multiple deals. So earnouts are also a way that sellers can do some of this, and that's earnouts are definitely still common, but they were more common before rollover came onto the scene. And the issue that makes rollover better than earnouts in terms of reducing risk is this alignment of interest is one of the two reasons. Hey, we're both thinking about a second exit or some terminal value in the business. That's what I want you focused on as my head of Midwest operations or my head of US operations or my CEO staying on to run the business. And so I want you to focus on that terminal objective as opposed to hitting a target in the next year or the next 2 years when the earnout period might happen. So that's one. And two, if I am leaving you in place to run my business or part of my business or somehow be involved in any capacity, and there's an earnout, we might end up in a fight because in an earnout, one side pays and the other side gets, or one side doesn't pay and the other side doesn't get, and you have a problem. And I don't want to have a problem with you if you're going to stay on and manage my business. So rollover, we're on the same side. We both want the same thing. It's not a zero-sum game with rollover as it is with an earnout. So yet another reason why rollover is growing in popularity. All right, so why rollover? Mathematically, just to summarize that real quick, mathematically, buyers need it to be competitive. They want to use the debt. They need to use the debt to be competitive, but the debt caps out and they have to fill the gap somehow. They want to align interests. A lot of important reasons, and hopefully it's kind of painfully evident now why rollover is becoming such a common ask for acquirers. So let's flip over to the other side of the table and say, as the seller, why would I accept rollover? I understand why you want it as the buyer, but why would I want it or agree to it? So again, we start off with some math, but this is much more simple math. And so the example here, I think let me just lay out this term 4 times cash on cash return, and then we'll get into the applying it here. So you'll often hear this from a buyer when they talk about rollover. And again, this is driven by your private equity funds, your financial buyers. So it's not every buyer talks about a 4 times cash on cash return, but it is part of what's driving the model because so many of the buyers are private equity funds right now. So the seller and the buyer are along for the same ride. So the buyer says, look, I have to give my investors a 30% annual return after I take my fees. And so I have to gain 30% or more a year on this business over my, say, 5 to 7 year holding period. And again, those can be shorter or longer, but we're kind of driving right down the middle of the fairway here. Over the next 5 to 7 years, I need a 30% return or more every year. And you and I you're gonna own stock, I'm gonna own stock. So if I'm getting a 30% return for my investors, you're getting a 30% return for your investors. Who are your investors? Oh, you're getting the same 30% return per year for you. So as I mentioned, the holding period is probably 5 to 7 years. And depending on how often you compound that 30%, basically in 6 years, it quadruples. In other words, 4 times. It goes up in value 4 times over a 5 to 7 year period. At 30%, depending on your compounding periods. And that's why they say they seek a 4 times cash on cash return. So going back to our example of a business is worth $100, but remember, how much did private equity put in? They didn't put in $100, so they don't need $400 when they go to sell. They only put in our first example, which is the more common example, $40. And you theoretically put in $10. So they only need to get a 4 times return on their cash, their $40. It could be called 4 times cash on equity, but I guess that doesn't sound as cool, so they all say cash on cash. You figuratively put in $10 cash, so you should get $40 cash out. They figuratively put in $40 of cash, so they should get 160 out. That's a 4 times cash on cash return. Sometimes buyers talk about it 3 times, maybe if they have a shorter holding period, or they talk about 5 times if they're trying to, be aggressive, or maybe they have a really good track record. But again, right down the middle of the fairway, 4 times cash on cash is what we usually hear. So, but is that realistic, right? So you will have worked with your broker and your attorney to do a lot of things to market and sell your business to this buyer that you're sitting across the table from, discussing potential rollover in your deal structure. And now they need to sell you on this new business. So I mentioned earlier, this kind of like you're kind of thinking about like retaining 20 or 25% of the business, but it's not really. This is a new business, whether it's legally a new corporate entity or not. The business after the closing will be vastly different than the business before the closing. 2 obvious reasons. The debt scenario will have changed significantly. We've yet to come across a client that has that much debt on their business, as long as assuming a growing, healthy business. So the business is going to have more debt on it. It's going to have to make interest payments. It's going to have to make reports to lenders on a periodic basis. And that's one sense that is different. The second thing is it's going to have different ownership structure. So it may have been operated by you individually, or you and a small group of family members or friends or associates, or maybe you've brought in a few outsiders over the years. But this is a very different ownership structure. It's going to be more formalized. There are going to be more layers, more processes. And a third thing that's going to make it different is it should be, if you're growing your business well, it should be growing faster. Buyers are not going to come in and offer you a price for your business unless they believe it will grow faster in their hands than it would alone in your hands. So it's going to be on an accelerated growth path with everything geared towards accomplishing that accelerated growth. So it's really a different type of business. So now that party across the table from you is buying, they're asking you to give them 80% of the business for $90 in our example, but you're also asking them to give you 20% of the business for your $10 in our first model. So the tables flip a little bit, and the main way that they're going to say, yeah, you should put this $10 back into the business and hold 20% is because they're going to talk about this 4 times cash on cash return. So it's entirely fair. They've just given you projections. It's entirely fair for you to then say, all right, convince me that my $10 could be worth $40 someday. And that's one of the things that you do when this subject comes up. So how are they going to make that realistic for you? Well, the first thing that they're going to do, could you quadruple the size of my business in 5 years? That doesn't seem realistic. And they can say, okay, that's not how we do it. First of all, remember, we're using $50 of debt in this example. So the first thing we're going to do is pay down the debt. So if the business has a value of $100, and on the day of the closing, $50 belongs to the debt providers, and $50 belongs to the equity provider, including you, providers, including you. Every time you pay down $1 of debt, assuming the value of the business just stays at 100, it doesn't even grow. You pay every $1 of debt you pay down moves $1 of ownership value from the provider of debt to the provider of equity. So if you pay down half the debt, your $50 that you and your co-investor have put into the business is now worth $75. You pay off all the debt, and the equity is now worth $100. So if they've used 50% debt, you pay down all the debt, you've already doubled the value of the equity. Your $10 is now worth $20, even if the business doesn't grow at all. So that's what you would call a 2x return, or a 2 times cash on cash return, if that was the only change. So now, rather than quadrupling that $100 value of the business, they only need to double it. It's much more realistic to assume that in 5 to 7 years, you could double the value of a business, right? So the 4x return comes from 2x paying off debt, 2x from growing the business. Doesn't that sound much more reasonable? To most of our clients, it sounds very reasonable. So that was the first reason why you'd want to accept it. I can get a 4 times cash on cash return. Now let's move to the second reason. In reality, the rollover probably fits with the reasons why you decided to take your company to market. We have very few clients that come in and just despise their business and just want to be rid of it, particularly because we deal with successful businesses. And we have very few who are, at the end. Most owners are well informed enough about the market that they understand that the way you get the maximum value is you come in and you commit to being around for up to 5 years afterwards. And that's really how you're going to get top dollar for this investment you've been making over the last 20 or 30 years of your life. So the real reason they come to us is one of two reasons. One, they want to take back some of their time. They don't necessarily want to be not in the business, but they want back some of the time because they're owner operators, and what used to be a 50-hour-a-week job is now a 60-hour-a-week job. And they're doing a lot of parts of running the business that they never wanted to do. The second reason is that they want to take the business to the next level. They want to find a way to accelerate the growth. And maybe now they're in their 50s or 60s and they have made plenty of money off the business, but they realize that to take it to the next level, they're going to have to go out and buy a new piece of real estate, lay a big slab of concrete, and put up a $40,000 facility. And they're going to have to pay for that either out of their own cash or partially out of their own cash or with a loan. And they're going to have to put a personal guarantee on the loan. And given where they are in their life, yeah, they'd love to see the business grow fast, but they're really not into reinvesting as much as they were when they were younger. So they're looking for someone to come help them take that business to the next level. And both of those objectives are very achievable with rollover. And at the same time, kind of the third most common reason that owners come for us is they want to take some chips off the table. They want to de-risk. They want to diversify their investments. And so it absolutely allows you to take your chips off the table. So look, in the example that we started with, it allows you to take 90% of your chips off the table and leave 20% of your chips on the table. And again, that's the most common deal structure that we've been seeing over the last couple of years. And then I think maybe more importantly than a lot of clients will admit to us, it allows them to maintain their love affair with their business that they've always had. They started it when they were 18 or in their 20s, or maybe it was passed to them by their mother or their father. It's family business, and it allows them to stay in it, but to do it in a better way. Our clients typically, as most people tend to do in life, as the business grows, they take on more and more responsibilities, and the responsibilities they have grow and grow. When payroll was 10 people, it was easy to manage. Now it's 50. It's hard to manage, but for some reason they're still doing it. It's human nature. So they find out when they kind of start the process, if they don't already realize it, that I don't hate the business. I hate having to calculate the commissions every month. I hate having to think about the personal guarantees on the loans or the leases that I've had to make. But you know what I like? I like sales. I like the design functions of the business. I like programming. I like strategic thinking. I like leadership. I like being the go-to person in the business. And doing a transaction like this with the rollover allows them to keep the parts that they want. Again, you have to find the right buyer, but it allows them to keep the parts that they want and kind of get rid of the parts that they don't want, and reset their whole role and reimagine their role within the business into something that's much more attractive and different than what they've been doing for the last, say, half of their ownership, where they've been bogged down with too many details. And so that's yet another reason why the rollover model is so attractive. And then I think lastly here, I want to say that, most of our clients aren't familiar with the type of buyers that we bring to the table. So when they sit down at the table with them, after they've had a first meeting, they're generally very excited about the people, and they realize, wow, these people look at things differently than me. I've been doing this 20 or 30 years. It's been great, but what am I going to do for the next 5 or 10 years? Well, I could be doing something a little bit different. Still in there with my business, still making good money, still around with all the people I've been working with and I like so much. But wow, I could kind of have a next stage in my life. I could do something a little bit different, because and learn something that I think as we all get older, to some extent we kind of like to learn things just for the sake of learning them, even though we know we're not going to go out and start another business and reinvent, reuse all these skills. It becomes kind of an intellectually intriguing option as well. And also, a break from the norm, something different. I'll still be doing what I like, but I'll be doing something different. And worst comes to worst, hey, if the rollover doesn't work out, you still got $90 for your business that was worth 100 in a very hot market. You got 90, which is more than you might have gotten in a cool market if you sold 100%. So generally our clients find that the amount of money they're actually walking away with on the closing day is very attractive. And if this last $10 that they put back in, or this 20% doesn't work out, they've still done very well, in part because of the high multiples. Again, if multiples get down lower, sellers may change that equation, that mental equation. So it may not be for every seller. It may not be for every seller with regard to every buyer. There may be a buyer that comes in, offers a great value, a great deal. You think they're going to be great for your employees, they're going to be great for your customers, they're going to protect the brand, the reputation. You have no problem handing the business to them, but honestly, you just don't want to work with them. And that happens sometimes. And so I've been discussing generally so far why rollover is popular in the market for buyers and sellers, but that doesn't mean it's right for every seller or every situation for every seller. And you do have to think that through. And it's not necessarily something you can say before you start the process, because I've only explained it to you one way. As buyers come through, they will explain it to you different ways that may be more or less appealing. And again, every buyer is going to have a different individual, personality mix with you. So keep an open mind and just remember that what I've talked about so far is generally market stuff, not trying to say that it's necessarily right for you or your deal. All right, so I just jumped into the summary there, and that moves on to the third and final part. How do you make the rollover valuable to yourself? So there are a couple of things that our clients typically worry about, and these are all legitimate things to worry about here when they start thinking about rollover. What's the value of a minority stake in a business that's not publicly traded? It's not liquid. I can't run out and sell it to people or list it anywhere for sale. How do I get, what's the real value of that $10 that I put back in? Second thing is, what if we don't get along? What if the relationship doesn't work? Another one that tends to come up a little later in the process, clients start to think about, well, we're going to grow this business really quickly, and we already just took on a lot of debt, and they told me they're going to pay down the debt in order to get that 4 times cash on cash return. So how are we going to fund this growth? They're talking about going out and buying smaller companies and adding them in to expand the geographic footprint or do some vertical integration. That's going to cost money. So if more equity has to go in the business, is my $10 that bought me 20% at the end of the day, am I only going to own 5%? Because guess what a 4 times cash and cash return is on 5%? It's about what you put in. So dilution is a legitimate concern, and it can get fairly complicated, but it's one of the issues that gets discussed. And finally, what about control, right? So for the owner operator that's staying on, obviously they're not going to own 80% of the business and let me do whatever I want to do. And for the last 30 years, I've pretty much got to do whatever I want to do. So there's going to be some change in how that works, and how do I get comfortable with that? And will this particular buyer come up with a solution that works for me? So these are the big issues that make it as I said, 3-dimensional or a 3-variable equation, and make it more complex than just doing a simple 100% sale of the business. So now, quickly here in the last 10 minutes, because then I'll leave about 5 minutes for questions, I'm going to run through the top 10 ways that you do it right. You do the rollover right in order to address those 4 issues and other smaller issues that come up. So the first one I've mentioned already, make sure that the sources and uses of funds table has the correct ratios and that the buyer is not somehow taking credit for the debt that they're going to put on the business as part of the deal in the equity base. And again, it happens more than it should. So a simple thing to check, a lot of times we'll get a letter of intent in from a buyer that doesn't have the sources and uses table, and we'll tell them, hey, please go back and put it in there before we show it to the client, because they're going to want to know about this because there's rollover. And then the separate issue comes up, they're just kind of taking a guess when they do the sources and uses. They're not contractually bound to structure the deal that way, and things change, and the amount of leverage they can get might be a little less or a little more than they thought. So that sources and uses has to be continually revisited as the negotiations continue after the letter of intent is signed, and there needs to be a check at the end to make sure that the ratio is still correct. And so sometimes, it'll say you got to put in $10 to get 20% of the business, and by the time the deal gets done, the seller's only putting in $9 to get 20%, or they're putting in $11 to get 20%, and that just needs to be tracked from beginning to end to make sure that the numbers always remain correct. Second issue is the buyer and the seller should hold the same class of securities, right? The same class of stock if it's a corporation, the same membership interest. There should not be any preferential return to the buyer, right? Because we're trying to align interest here. And a 4 times cash on cash return is a nice objective, but if the buyer is pulling out an 8% preferred dividend every year and you're getting no dividend every year, they're not really getting a 4 times cash on cash return. They're getting maybe a 5 times cash on cash return, and you're getting a 4 times cash on cash return. And so one of the things that we always make clear with buyers when the subject of rollover comes over is our clients will be taking the same class of securities as you. What buyers will oftentimes try to do is be very vague about it in the LOI, and then when the purchase agreement starts coming out, you start seeing 2 different classes of stock, and it's not really clear what the differences are, and they say they'll put them in the articles of organization, and those come out a couple weeks after the first draft of the purchase agreement, and then you're trying to get things closed, and this is coming in at the last minute, and maybe something will get overlooked. So we make that very clear right from the beginning. It saves on legal fees, it saves on time, it saves on negotiating issues. Our clients and you will have the same class of stock. And so buyers don't always agree with that, and they put up a fight. And I think that comes from, again, back in the days of venture capital, and think about the tech bubble from mid 90s to about 1999, and how those minority investors were taking 20% and giving themselves all kinds of preferred stock with all these preferred liquidation rights and voting rights and everything. And then a lot of those people that used to do venture capital have now moved into middle market, lower middle market private equity, and they've brought that concept with them. And even though they're now the majority shareholder, not the minority, they still try to get some super majority types of rights and preferred dividends and things like that. And we view that as not being appropriate in this market, and we get most buyers to agree to that. And it has been something that's killed some deals because our clients see the value that they're losing by giving up, having 2 different classes of stock. So if you can nip that one in the bud early, these first 2 are kind of technical points. They're easy to handle. You just got to follow up and do them, but you got to start that early in the process. All right, so then getting a little bit more nebulous here, there need to be discussions between the buyer and the seller discussing, an alignment of the valuation expectations. So if you haven't had that 4 times cash on cash return, how are we going to get there, and how are we going to pay off the debt? You need to have all those discussions to make sure that you're, opening into the relationship with, entering into the relationship with openness. Number 4, liquidity plan. So there has to be some way that you can liquidate your holdings and convert that 20% interest back into cash when the time comes. And the simple response from the buyers is, again, kind of using financial buyers as a model. Yeah. We're gonna sell the business for a huge profit in 5 to 7 years. Okay, well, what if you don't? And so typically, what kind of sellers that aren't well represented, they'll cover the upside scenario. If everything goes well, this is how it works, and they can kind of run those numbers themselves. If everything goes very poorly, here's how it works. But what oftentimes gets forgotten, and got forgotten all the time with venture capital and the dot-com bubble, is kind of what's called the walking dead, where the business doesn't grow and have a huge successful exit, nor does it head towards liquidation. It just kind of keeps growing. Maybe it keeps growing at 5% a year, but when time comes to sell, regulations have changed, or the markets aren't good, or the industry is falling out of favor or something, and you just can't, it just isn't right to sell when it's time for the rolling seller to enter that second transaction and get out. And you have to contemplate all three of those scenarios. Don't overlook the Walking Dead. I think Walking Dead, it's not, that sounds a little bit negative, but it's because it comes from the investors, right? So they're thinking, I'm not going to get my 30% return on this if I sell it right now. So they're thinking it's Walking Dead, but the business is perfectly healthy. It just hasn't achieved the objectives of the investment. All right, number 5 out of our list of 10. I mentioned this earlier. How are we going to handle it if additional capital is needed? What are we going to do? Are we going to borrow? Are we going to put in equity? How is it going to be handled? What effect will it have on my dilution? So that's definitely a discussion that needs to be held beforehand. And at a minimum, we always have for our clients what's called pay-to-play protection. There's all these great little buzzwords in the industry, right? So what that means is if I own 20% of the business and we need to go out and raise another $100, I get the right to fund 20% because I own 20% of that $100. So if I put in $20 at the end of the thing, I'll still own 20%. So that pay to play, meaning that if you pay the rate as everyone else, you can maintain your percentage interest in the business. We put that in at a minimum, and then it gets very sophisticated beyond that of other issues of anti-dilution. But you need to make sure the issue is brought up and discussed early in the process. Okay, I mentioned control being one of the 4 issues that's a big deal. And again, we could talk about this for days, but what I want you to take away here is that you need to be thinking about control on 3 levels. And most of our clients haven't traditionally thought this way because they in a small group of partners have been all 3 levels of control. But in these deals with the rollover, control is looked at 3 different levels. There's the ownership level. So if you're selling someone 80% of the business, you should assume that they're going to have the ownership level controls. And yes, there are some minority protections that should be put in place for you, but generally ownership control is going to go to them. The second level is the board level, or in a LLC, the kind of statutory manager level. And what we usually see there is the controlling shareholder has the right to exercise that control, but they show tremendous restraint and they don't want to get involved in it. So, and they don't want responsibility for it. So that's kind of set up where the rolling over seller can have control of that unless something happens, in which case they then, the controlling shareholder has a right to step in. And then the third level is the operational control, right? The CEO, the regional manager level, the financial issues. And this is where generally this control is left to the seller. So I think a lot of times when our clients first start talking about control with the buyer in a rollover context, they don't see a way out. They don't see how it can possibly work. And then once we sit down and say, look, let's look at these 3 levels, and and then they have that conversation with the buyers, a 3-level approach. They say, okay, I understand that they need the heavyweight stuff at the top, but they're going to give me the important stuff down at the bottom that is really what drives the business, and that's what I can live with. So again, you can go on, but always think about it at 3 different levels, because that's the way it will be broken up in the documents once the deal is papered. All right, lock in the distribution and compensation policies, right? So if you're going to stay on and be the CEO or the regional manager or whatever you're going to stay on and do, you should get compensation. You should be compensated at market rates as if you were not an owner. And that compensation should be a clean break between your employment compensation and your compensation for selling the business. They're 2 different things, and you need to look after that compensation and get it on market terms. The distributions, right? We talked about a 4 times cash on cash return at the end, but now we're talking about the money along the way. Compensation, distributions. Is the company going to pay dividends? Is it going to pay out distributions? If it's an S corp and going to remain an S corp, is it going to at least give you tax distributions to cover your tax bill? The answer should be yes to that last piece. But you need to make sure you're on the same page. We had a deal last year where we brought 2 buyers that were beautiful, just perfect buyers. The client loved both of them. One of them was going to use a huge amount of debt and therefore not pay out any dividends because they needed the cash to pay down the debt as well as grow the business. And the other one offered the exact same deal, but was going to use no debt. And they said, look, the business kicks out so much cash, we can't possibly grow fast enough to use it. So we plan to pay dividends every year. And that was actually the primary difference between the two offers that the client, used to make their decision. So whether or not there will be distributions, big issue that should be discussed ahead of time. All right, the last 3 items on this list, probe the buyer about their past experience. Remember that you're going into partnership with them, you're making an investment in a business that they're going to have the ultimate control over at the operational level. So you get to do some due diligence. Talk to their other partners that they've had rollover, some hopefully that still work with them and some that work with them and then had their second exit. And they'll usually provide the names of those and authorize, and arrange for you to talk with them. All right, number 9 and 10, these are kind of summary points, right? But think about the consideration you get absent rollover. A lot of times 1 through 8 cause a lot of heartburn with the clients. They don't see how they're going to get the deal done with it. They're going to cause the deal to tank. As I said, it's hot in terms of touching a stove. But then somebody says, hey, look, sit back. You're selling your business. You're getting 90% of the money right now. And if that was the only money you got for your business, would you be okay with that? And when they think about it in that context, that allows them to be a little more flexible on these kind of issues 1 through 8 and help get the deal done, particularly when the multiples are so high. Number 9, final point. Take a step back. You probably haven't thought of your business as an investment, right? Do I buy 100 shares of Microsoft or do I put that money into my business? Probably not been your mental dynamic over the last 20 or 30 years as a business owner, but step back and look at it that way. Okay, so, I'm being asked to invest $10 in the example in this business. What do I think of it as an investor? Not as the former owner, not as the person who's going to run it, but as a former owner. What do I think of it as an investment? Does it make sense? If someone walking off the street and offered me the opportunity to invest in this, would I do it? Right? So think about it that way. And then, of course, say, but oh, yeah, and I am staying on as the CEO or in whatever capacity, so I am going to be able to have a little more control over things. And I think, when we're having problems with clients and they think through bullet point 9 and 10, it helps get over those last hurdles and solve that 3 variable equation. So to summarize that third of our 3 subjects, how to do it right, it gets done all the time. It seems very daunting. The issues are not generally obvious to our clients when the process of discussing rollover starts, and one by one they come to them, whether it's through discussing them with us or whether they, just kind of they're at home at night, not sleeping, thinking about the deal, and it pops into their head in the middle of the night. But these issues come up and they get addressed, and it happens over and over again. Yes, it does kill some deals, but if you look at those 10 steps that we just went through, it's some good ways to prevent the rollover issue from killing the deals and taking that heat out of the situation. So I've gone just a little bit over here, but that wraps it up, and I have time for questions. Sydney, any questions?
It looks like we have 2 questions. The first question, does buyer appetite for rollover depend on the industry of the seller's business?
Yeah, to some extent it does. So the biggest determinant of appetite, the 2 biggest determinant of appetites are the multiples being paid. The higher the multiple, the more they're going to want rollover, and whether it's a strategic or a financial buyer. So financial buyers are going to want, they're going to be more interested in rollover. A higher percentage of them will be interested in rollover than your strategics. But in terms of the industry, I'll say yes. To the extent it's an industry that's based more on personal relationships and has, say shorter term contracts, so there's not like a huge contractual backlog that the buyer can rely on, they're going to want more, the buyers will be interested in rollover or make it a condition of the deal. Because remember, that's about taking that risk out. So businesses that have very little risk because they have long-term contracts in their industry, and it's not about personal relationships as much, are going to have a little bit lower interest in rollover when it comes to buyers, as opposed to the ones where everything's bought on short-term contracts, or the contracts may be long-term, but they're not actually for fixed amounts. So I think that's the most important dynamic of the industry. So you tend to see kind of personal services businesses will have higher percentages of rollover, I'd say more kind of towards 30% sometimes on those. Whereas say a manufacturing business or distribution business or some service businesses that are maybe B2C will have less interest in the rollover. Yeah, so those are the key variables: industry, strategic versus financial, and how high the multiple is.
The next question is, you mentioned that lenders will go up to 3.5 times. That sounds like a lot. How do they get to a number that high?
Okay, so not every business can support 3.5 turns of debt. That's the highest. And so one way they achieve that is they have a relationship with the buyer, and they've loaned the buyer money in the past. So they're going to be much more comfortable loaning money to that buyer than they would be loaning it to you, the business owner, who came up, through your own sweat, but they don't know you and they haven't loaned money to you in the past that you've repaid. And I'm not talking about who you might have as a bank for secured loans or your revolver. These are specialized lenders that lend to M&A buyers, particularly private equity funds most often. And so they have a little bit more appetite for risk in an M&A context than the lenders that you as a business owner would know. So that's one way, is their relationships with the right kind of buyers. The second way is that, there may be in the background some recourse that they have to other investments in that buyer's portfolio or other assets that you don't have or your business doesn't have. So anytime you have more collateral, you can get more debt, lower interest rates. So that's the second way. And the third way is that they will normally have two kinds of debt on an M&A transaction. It'll be the senior debt, which is the kind that most of our clients are familiar with, which you grant a security interest in the property of the business as collateral, and it's a longer term loan, and you get that, single digit interest rates, and that's more like the loans that our clients have seen in the past. And they'll get that for maybe 2.5 turns, and that's where our clients might say, "Wow, I could never get more than 2.5 turns no matter what." Well, that's true, because that's the kind of debt the kind of debt that you have access to. And then that last half a turn or turn of EBITDA, right, the last 0.5 or 1 times EBITDA will come from something called mezzanine debt, which is not generally available to operating companies, but it'll be shorter term debt with double-digit interest rates. And the reason that the buyers will use this is because they're going to pay it off very quickly. And so they'll use that to bridge the gap between, they'll try to get as much senior debt as they can at single-digit interest rates. And then if they want to use 40% debt or 50% debt, they'll buy that expensive mezzanine debt to get them to where they want to be, and then they'll pay that off very quickly. And so again, the ability to pay off that mezzanine debt quickly is a very large determinant in hitting the 4 times cash on cash return. So this is actually the reason why rollover is so good, because they want to make sure that there's as little risk as possible until that mezzanine debt gets paid off, because it's very high interest, and they don't plan on keeping it outstanding for the full term of the loan. So they want the deal to close, they want to hit the ground running. They don't want 6 months adjustment period for new management to come in and run the business. They don't want to fight over an earnout after the first year between them and the CEO that stayed on, the former owner who rolled over, for example. They want those first years to be smooth. It's so important. So the rollover, as I said earlier, is something that really helps out those first years, especially. And those first years being when they have so much debt, it is of extreme importance. So mezz debt is really the third way that they can get it up that high. And lastly, I'll just say, it's not every business that can go to 3.5 times. We have gotten 3.5 times, even on very asset light businesses that don't have long-term contracts, but it is a harder lift to get that. So, if you're in professional services, if you have customer concentration, you could be looking at 2.5 turns with 3 turns being the cap on the debt, even with the fancy mezzanine stuff tucked in there. So I think that addresses it. All right. Well, thank you for joining us. I remind you again of the 3 PDFs that you can download, especially the one about how to see us on social media. to get some more content from us on various different subjects. And we look forward to hosting another webinar that you choose to attend. Thank you very much.